In this video, we're going to look at the different ways of trading stocks, whether you're using individual shares or contracts for difference. Hello, I'm David Jones, and in this latest video with Trading 212, I thought we'd look at a compare and contrast between two different ways of getting exposure to the stock market, trading individual shares or using a derivative product called a contract for difference, often known as a CFD. Now, CFDs have really grown in popularity over the last 20 years amongst retail private investors. They use them for trading indices, currencies, commodities. But where they started was for individual shares. So let's start off. Let's look at the different benefits and drawbacks of using these two approaches. So first of all, let's look at the main headline differences of trading shares, stocks, equities, whatever you want to call them, with these two different approaches. So on the left-hand side, we have equities, so buying traditional shares or stocks, whatever name you want to give it. And on the right-hand side, we have CFDs, contract for difference, the derivative based off what the share price is doing. I think the main headline difference is this idea of leverage. Now, we've talked about this before in a video, but just to recap, when you're using leverage, in effect, you're getting more bang for your buck. So let's say you're going to buy £10,000 worth of shares. Let's look at both approaches. So if we're buying 10,000 of actual physical shares, physical equity, typically there's no leverage if we're buying shares. So if you want to have £10,000 worth of BT, for example, you need £10,000 in your account, plus the commission, plus the stamp duty. We'll come to all that in a minute. But with CFDs, we're trading on margin. So let's say the share we were going to trade was on an initial margin requirement of 10%. What that means is we only have to put up 10% of the value of the position. So we've still got a £10,000 exposure to this particular share, but our initial margin is only £1,000. So we are getting more bang for our buck. Of course, the risk is if the share is falling, if we've bought it and it's falling, we've bought via a CFD, we need to make sure there's enough money in the account to cover those running losses if we need to run the position. But this leverage is the big headline difference between the two of them. Now, the next big difference between CFDs and physical shares is actually the direction you can trade them in. Traditionally, with individual equities, individual shares, as a private investor, you're limited to trying to profit if the share goes up. So you're hoping to buy low and sell at some point higher up. Now, if markets are falling, one way of making money is to short sell, to sell high and buy back lower. But it's very difficult, if not impossible, for your average private investor to do that through a traditional share buying account. But with CFDs, contracts for difference, you can trade them in both directions. So it's just as easy to put a trade on expecting the price of, let's say, Netflix to fall and profit from it, as it is if you thought the price of Microsoft was going to go up, so you're going to buy it first. So you can trade it in both directions using CFDs. You can't do that with individual equities. Let's look at some of the costs. For UK equities, at least, if you buy shares in a UK company, traditionally there's stamp duty to pay. So it's a tax basically made by the government of around 0.5% on a share purchase, on the total value of the shares you've bought. So there's a tax there. With CFDs, because they're not actually the physical shares, it's a derivative, there's no stamp duty to pay. So there is a saving there. Another cost actually that you have with CFDs, contracts for difference, that you don't have with equities, financing. And it's all because of this leverage here. You know, if you're buying £10,000 worth of shares in British Aerospace, but you're only putting up £1,000 to control that position, in effect, you're borrowing money off your broker to do the trade. And as we all know, when you borrow money, there's a small financing cost. There's a small overnight financing cost to reflect your total exposure. Just to show this very quickly on the platform, let's search for a US share, Netflix. So we'll type Netflix into the search box, and you can see straight away we've got two options. We can trade the CFD, so using leverage, we can trade it in both directions, or if we want, we can buy the physical shares. Okay, so the difference is CFD there, EQ for equities there. So we have the choice depending on which approach we want to take. So there you have it. I think if you were looking to hold a share for, let's say, 12 months, 2 years, 5 years, probably buying the physical shares is the way most people would do it. But for other short to medium term trades, there are definite benefits in using contracts for difference. Of course, if you're trading shares through Trading 212, you get commission free trading up to a certain amount of trades per month. Go to the website to find out more, and there's only a small commission if you're trading using CFDs. But we'll start wrapping things up there. As usual, any questions or comments or you're not sure of anything, leave us a message down below. If you like the video, click on the thumbs up, and to never miss out on any of the stuff we do during the week, we push up a whole load of videos on different market topics. Make sure you're subscribed by clicking the subscribe button there and then clicking the alarm bell notification down there. But for this week, from me, David Jones and Trading 212, we'll leave it there, and I hope you have a good trading week.